In the last 2 years, central banks around the world have been buying gold at the fastest pace in recorded history. Not hedge funds, not retail investors chasing a trend. Central banks, the institutions that manage the monetary reserves of sovereign nations, the same institutions that for decades were actually selling gold, arguing that it was a relic, a barbarous metal with no place in a modern financial system. Something changed, and if you understand monetary history, if you've studied what happened the last 5 times a reserve currency began its long decline, you know exactly what changed because you've seen this exact behavior before, every single time. This is not a video about whether gold will hit $3,000 or $4,000. The debate about gold is as old as modern finance itself, and it has always taken the same form. On one side, the pragmatists, the economists who argue that gold is just a metal, that its value is arbitrary, a collective delusion sustained by tradition, that in a sophisticated modern economy, with central banks and financial instruments and digital payment systems, there is no rational reason to treat a shiny element as the foundation of monetary order. John Maynard Keynes called the gold standard a barbarous relic in 1953. Most mainstream economics textbooks today treat gold as a curiosity, a historical footnote, something people used before they knew better. On the other side, history, not theory, not ideology, history. The documented record of what has actually happened across 5 centuries of monetary systems, reserve currency transitions, and empire cycles. The historical record makes an argument that is difficult to dismiss once you actually look at it. Every paper monetary system in history has eventually failed, has been inflated away, abandoned, redenominated, or replaced. Every commodity-backed system, including every gold standard, has endured for as long as governments kept their promises and failed when they stopped. And through all of it, through every collapse, every transition, every new monetary order built on the ruins of the old one, gold has survived, not as an investment that returned 10% a year, but as a store of value that carried purchasing power from one monetary era to the next. That is the only argument gold has ever needed to make, and it has been making it for three. Most people think they understand the gold standard. Most people are wrong. The popular understanding goes something like this. Once upon a time, paper money was backed by gold, which made it reliable. Then governments abandoned the gold standard, which freed them to manage the economy more flexibly. And while there are people who want to go back to gold, that's generally considered an outdated idea that serious economists don't take seriously. This version misses almost everything important. The gold standard was not a single system. It was a family of related monetary arrangements that evolved over roughly 2 centuries from the early 1700s to the mid-1900s. At its peak, the classical gold standard period from roughly late 1970 to mid-1930 here. It represented something genuinely extraordinary, a global monetary order in which currencies of dozens of countries were fixed to gold, exchange rates were stable, international trade expanded at an unprecedented pace, and capital flowed freely across borders with minimal friction. This era, the Victorian and Edwardian period, was the high water mark of British economic and financial power, and it was not a coincidence that Britain was at the center of the gold standard. Britain had adopted gold as the foundation of its monetary system in 1820, and the pound sterling, backed by and convertible into gold, became the world's reserve currency precisely because it was credible. Foreign governments, foreign merchants, foreign investors trusted pound sterling because they knew it would hold its value. They knew this because they could exchange their pounds for gold at a fixed rate. Trust was the product. Gold was the mechanism that made trust credible. The system had a built-in discipline that is crucial to understand. If a country ran a large trade deficit, if it was importing more than it was exporting, gold would flow out of that country to pay its creditors. As gold left, the domestic money supply contracted, prices fell. The economy became more competitive. Exports picked up. The deficit corrected. The gold came back. It was automatic. It was impersonal. And it was, by the standards of financial history, remarkably effective at maintaining stability. But it had one profound weakness. It required governments to accept discipline they did not choose. It required them to let their domestic economies contract when the external balance demanded it. It required them to prioritize monetary stability over full employment, over welfare spending, over the political pressures that modern democratic governments face constantly. In peacetime, with limited government spending and relatively narrow electorates, this was manageable. Then came the First World War. The war required spending on a scale that the gold standard could not accommodate. Britain, France, Germany, every major belligerent suspended gold convertibility in milnepsin kutarsın. They printed money, they borrowed, they inflated. 4 years of industrialized slaughter was financed not by gold but by faith, faith that governments would eventually honor their debts, faith that currencies would eventually return to their pre-war values. Some of them did, most of them didn't. Not really, not sustainably. Britain returned to the gold standard in 1955 at the pre-war parity, a decision that Churchill, as Chancellor of the Exchequer, made against the advice of Keynes and that he would later call the biggest mistake of his life. The pound was overvalued. British exports became too expensive. The economy stagnated. Unemployment rose. The discipline the gold standard demanded was discipline Britain could no longer absorb. The Great Depression finished the job. By 1931, Britain had abandoned the gold standard entirely. The United States followed in 1933 when Roosevelt prohibited private gold ownership and effectively devalued the dollar against gold. The classical gold standard, the system that had underpinned the year is 1944. The war in Europe is not yet over, but its outcome is no longer in doubt. Representatives of 44 allied nations gather at a resort hotel in Bretton Woods, New Hampshire, to design the post-war international monetary system. The question they faced was simple to state and almost impossibly complex to answer. The old gold standard was gone, killed by 2 world wars and the global depression, but international trade required a stable monetary foundation. Floating currencies with no anchor would create the chaos and competitive devaluations that had plagued the 1930s and contributed to the political instabilities that led to the Second World War. Some new system was needed. Two visions competed at Bretton Woods. One was proposed by Keynes, representing Britain. He envisioned a genuinely international monetary institution, a global central bank, issuing a new international currency he called the Bancor, with automatic mechanisms to adjust imbalances between surplus and deficit countries. No single national currency would be privileged, no single country would bear the burdens of being the anchor of the system. The other vision was proposed by Harry Dexter White, representing the United States. It was simpler, more practical, and reflected a basic reality that everyone in the room understood. America held 2/3 of the world's monetary gold. America was the only major economy that had emerged from the war stronger than it entered. America was simply and undeniably the dominant economic power on earth. The system White proposed gave that power formal institutional expression. Under Bretton Woods, the dollar would be the anchor currency. The United States would fix the dollar to gold at $35 per ounce and would commit to exchanging dollars for gold at that rate for any foreign central bank that requested it. Every other currency would be fixed to the dollar, which meant they were indirectly fixed to gold through the dollar. The system was essentially a gold exchange standard with the dollar as the intermediary. Keynes lost, the American proposal won, and for the first 2 decades of the post-war era, it worked extraordinarily well. The dollar became the global reserve currency. US Treasury bonds became the world's safest asset. The institutions created at Bretton Woods, the International Monetary Fund, the World Bank, structured global finance around American primacy. But the Bretton Woods system had a flaw buried in its design, a flaw that Robert Triffin, a Belgian-American economist, identified in 1916, and that would destroy the system 11 years later. Triffin observed that for the dollar to function as the world's reserve currency, the United States had to supply dollars to the rest of the world. Foreign governments, foreign businesses, foreign investors needed dollars to conduct trade, to hold reserves, to participate in the global economy. Here is a fact that should stop you. In 2022, 2023, and 2040, central banks bought more gold than in any comparable period since records began. The World Gold Council's data is unambiguous. Countries across the global south, China, India, Turkey, Poland, the UAE, Singapore, have been systematically accumulating gold reserves at an accelerating pace. China's official gold reserves have increased by hundreds of tons. Russia, cut off from the dollar system by sanctions, has been the most aggressive gold buyer of the past decade, but the trend extends far beyond countries that have an ideological reason to move away from the dollar. Countries with no obvious geopolitical motivation, countries that are close American allies, have also been quietly adding to their gold holdings. Why? The public statements from central bank officials are careful, diplomatic, technical. They talk about diversification. They talk about managing risk. They talk about long term strategic asset allocation. What they are not saying, but what the data strongly implies, is this: the institutions that manage the monetary reserves of sovereign nations, the people whose entire professional existence is devoted to understanding monetary history and managing monetary risk, are behaving as if the dollar centric system that has governed the world since Bretton Woods may be approaching a transition point. This is not a fringe view. Ray Dalio, who spent decades interviewing central bankers, policymakers, and institutional investors as part of his research into the changing world order, is explicit about it. The accumulation of gold by central banks is one of the indicators he identifies as appearing reliably before a reserve currency transition. It is the smart money repositioning before the broader market understands what is happening. The smart money does not announce what it is doing, it acts, and then ordinary investors, years or decades later, look back and realize the signal was there the whole time. The historical record on gold during reserve currency transitions is specific and consistent enough to deserve careful attention. When the Dutch guilder declined in the late 17th and early 18th centuries, the Netherlands' gold reserves became a critical asset during the turbulence of the transition. Dutch merchants and financiers who held physical gold outside the banking system preserved far more of their wealth than those who held guilder-denominated financial assets, which were repeatedly devalued as the Dutch state struggled with its war debts. When the pound sterling declined through the first half of the 20th century, the pattern repeated. The British government's decision to leave the gold standard in Ministeriente Unt and the subsequent devaluation of the pound destroyed a significant portion of the purchasing power of pound-denominated savings. Gold held outside the banking system held its value. The British citizens who were legally permitted to hold gold in some 1931 before the various restrictions that came later, and who had converted a portion of their savings into physical metal during the warning period of the 1920s, were significantly better positioned than those who trusted the currency completely. The same pattern appeared in every major currency devaluation and monetary crisis of the 20th century. In Weimar Germany's hyperinflation of 1928-1933, gold preserved purchasing power while the papier mark became worthless. In Argentina's repeated currency crisis. In Turkey's long inflation story. In every case where a paper monetary system came under severe stress, physical gold served the function it had always served, a store of value that carried wealth across the transition. There is a crucial distinction to understand here. Gold does not generate yield, it does not pay dividends, it does not compound. During long periods of monetary stability during the post-war American century, during the 1980s and 90s, when the Federal Reserve had established credibility and inflation was under control, holding gold meant accepting inferior returns compared to stocks, bonds, or real estate. The case for gold is not a case for superior returns in normal times. It is a case for preservation of purchasing power in abnormal times. It is a case for preservation of purchasing power in abnormal times. It is insurance, and like all insurance, let's be specific about what is happening right now, because the data is striking. Gold has been one of the best performing major assets of the past 3 years. From a price of around $1,700 per ounce in late 2020, gold has climbed toward and at times above $3,000 per ounce. That is a move of roughly 75% in under 3 years, during a period when conventional wisdom said rising interest rates would make gold, which pays no yield, unattractive. The conventional wisdom was wrong. It was wrong because it misunderstood what was driving the gold price. It assumed gold was being bought primarily by retail investors hedging inflation. The dominant buyer was central banks. And central banks are not sensitive to interest rates the way a retail investor running a yield comparison analysis is. Central banks are sensitive to systemic risk. They are sensitive to the question of whether the monetary system they are operating within will remain stable. Simultaneously, something is happening in the gold market's internal mechanics that has attracted attention from monetary analysts. The traditional relationship between physical gold held in Western vaults, primarily London and New York, and gold demand in Asia has been strained. There have been unusual flows of physical gold from west to east. Delivery requests, exchanges have become elevated. The spread between paper gold prices and physical gold prices has periodically widened in ways that suggest the market for claims on gold and the market for actual metal may be diverging. This is not proof of an imminent crisis, but it rhymes with historical patterns. In every previous period of monetary stress, the gap between paper claims on gold and physical gold eventually became significant. The people who understood this distinction, who held actual metal, not financial instruments representing metal, were the ones whose wealth survived the transition intact. No honest treatment of this subject can skip the strongest arguments against gold as a strategic asset. The first argument is that gold has no cash flow. A share of a productive company generates earnings, a bond generates interest, a property generates rent. Gold just sits there. In a world of positive real returns on other assets, gold is a drag on a portfolio. This argument is real. It is why gold has underperformed equities over most long horizons measured from periods of monetary stability. The second argument is that gold's role in the monetary system is over. The world moved beyond the gold standard. Modern central banks have tools, inflation targeting, quantitative easing, forward guidance that can manage the monetary system without the constraints of gold. The fact that central banks left gold doesn't mean they'll return to it. The world has simply moved on. The third argument is that Bitcoin and other hard money alternatives have now taken on some of the monetary functions that gold historically served. Younger investors and institutional allocators who want hard money exposure are increasingly choosing digital assets over metal. These arguments deserve respect. The response from monetary history is not that they are wrong, but that they are incomplete. On the cash flow argument, gold's value is not as a yield-generating instrument. It is as a monetary metal, a claim on purchasing power that exists outside any particular monetary system. The question is not whether gold generates yield. The question is whether it holds value when the system generating yields on everything else comes under stress. The historical evidence on this specific question is unambiguous. On the argument that gold's monetary role is finished, the central banks buying gold at record rates know something that this argument misses. They are not buying it because they expect a formal return to the gold standard. They are buying it because in a world of competing reserve currencies, of the dollarization, of BRICS nations building alternative payment systems, of declining confidence in the US fiscal trajectory, gold is the one asset that is nobody's liability. Every other reserve asset is simultaneously somebody else's debt. US Treasury bonds are the US government's promise to pay. Euro-denominated bonds are a promise from the ECB. Gold is not a promise, it simply is. In a world where promises are becoming harder to keep, that distinction matters. On the Bitcoin argument, this is the most interesting challenge and the most historically novel. Bitcoin has properties that make it a legitimate candidate for hard money status: fixed supply, decentralization, resistance to confiscation. But it has 3,000 years less track record than gold. It has never been tested through a genuine reserve currency transition. Central banks are not accumulating it, and its volatility, while decreasing, remains enormous compared to gold. The people best positioned to assess these assets: sovereign reserve managers with deep institutions. This is where the historical record is both useful and sobering. Reserve currency transitions are not events, they are processes. The British pound's decline from dominant reserve currency to a regional currency took roughly 40 years, from the end of the First World War in 1978 to the final Bretton Woods arrangements of 1944 that formally institutionalized dollar primacy, and then several more decades of managed decline through the crisis of the 1950s, 60s, and 70s. 40 years is a long time. It encompasses entire careers, entire investment cycles, entire generations. What this means practically is that the question, will gold protect my wealth during a reserve currency transition, is not a question about what happens next quarter or next year. It is a question about what happens over a decade or two. Over that horizon, the historical answer is clearly yes, provided the transition is real, not imagined, and this is the honest uncertainty. Transitions that look like the beginning of a major reserve currency shift have appeared before and reversed. The dollar was widely predicted to lose reserve status in the 1970s after the Nixon shock and the oil shocks and the inflation of that decade. It didn't, in part because Paul Volcker's brutal interest rate hikes in 1980 and 1989 well restored confidence in American monetary management. Could that happen again? Could a sufficiently credible fiscal consolidation and monetary tightening reverse the current trajectory and preserve dollar dominance for another generation? The honest answer is yes, it is possible. The question is whether you see the political conditions for that outcome, whether you believe the United States political system. Every reserve currency in modern history ended the same way, not with a single dramatic collapse, with a slow tide going out, a gradual loss of confidence, a gradual reallocation of reserves, a gradual restructuring of global trade arrangements. And by the time it was obvious to the general public, the transition was already largely complete. The next video in this series goes deeper into something even more specific. What assets actually survived and which ones didn't in the portfolios of people who lived through the last three reserve currency transitions. Not gold alone, not stocks alone, but the actual structure of wealth preservation that history records as having worked. The combinations, the timing, the mistakes that even smart, well-positioned people made. If you're building a mental framework for the decade ahead, that's the video you don't want to miss. Subscribe, because macro history exists to give you the context that the news cycle never will.